Interest rates play a key role in the economy and have a profound effect on the lives of ordinary people like you and me. So what are interest rates? And why does it matter when they change? This is Interest Rates Explained by the Simple Economy. So when you lend money from someone, they demand an incentive to make it worthwhile to them to take the risk. They want to be paid a return in order to make a profit. The interest rate is the amount a lender will receive in profit, displayed as a percentage of the total amount they lend. So let's think about it in terms of banks. In order for a bank to agree to lending you money, they demand an incentive. Let's say 5% in this example. So if you borrowed £100 from the bank for 1 year, you have to pay them £105 back. That's the amount you borrowed, £100, and the interest rate charge of £5, which is 5% of £100. The same applies when you put your savings in the bank, only this time the roles are reversed. You are the lender and the bank is the borrower. The bank pays you an interest on your money. Now, when you read in the news that the interest rate is changing, they are talking about the bank rate. This is the most important interest rate, as it is used as the base for the interest rate we pay on our mortgages and loans, as well as the rate the bank pays us on our savings. As it is the central bank that creates and prints money, high street banks must go to the central bank in order to obtain money. The bank rate is the interest rate the central bank charge retail banks to lend money from them. The retail banks then take this money and lend it to you and me at an even higher interest rate in order to make a profit. It therefore makes sense that when the bank rate, the interest rate the banks pay for money, goes up or down, then the interest rate we pay to the bank also goes up or down in the same direction. So why would a central bank decide to change the interest rate? Well, it's very simple. They use it to control growth in the economy. They use interest rates to slow down or speed up growth. Think of it like brakes on a car. When the central bank lowers the interest rate, they are pulling off the brakes and the economy starts to speed up. When the central bank rises the rate, they're putting the brakes on and the economy starts to slow down. When the central bank think the economy is slowing and a recession may arise, they lower the interest rate, pulling off the brakes. When the central bank think the economy is doing well and they don't want growth to get out of hand, they rise the interest rate, putting on the brakes. So let's see how it works in practice. Firstly, lowering the interest rate. Interest rates are lowered when growth in the economy is slowing. Typical signs are that people are spending less, there is less demand for things to be made, unemployment is increasing, there is little or no inflation, and people are not buying new homes or investing. All of these are signals to lower the interest rate. The effect of lowering the interest rate goes like this. Existing debt becomes cheaper, new debt is cheaper, we spend less on debt, we have more disposable income, we spend more, companies make more profit, people feel richer than before, and we are encouraged to spend and invest as we now get a low return from our savings in the bank. You can therefore see how lowering the interest rate equals spending less money on debt, which equals more money to spend and invest in the economy. Now to raising rates. Interest rates are raised when growth in the economy is strong. Typical signs are that people are spending more, there is high demand for things to be made, unemployment is low, there is strong inflation, and people are buying new homes and investing. All of these are signals to raise the interest rate and ensure growth doesn't get out of hand. The effect of raising rates goes like this. Existing debt becomes more expensive, new debt is more expensive, we spend more on debt, we have less disposable income, we spend less, companies make less profit, people feel poorer than before, and we are encouraged to spend less and save as we now get a higher return from our savings in the bank. You can therefore see how raising the interest rate equals spending more money on debt, which equals less money to spend and invest in the economy. So there you have it. The next time you read the news that the interest rate has changed, you now know the likely cause and effect. Thank you for watching, and please subscribe to catch the next video from The Simple Economy.